Hi, everyone. Doesn't feel like Friday to you? Richard, hi. We're here, Hugo.
I wish it was, Dale. Morning, mate.
Feels like it, Ryan.
Yeah, long week.
Huh?
Long week, eh?
Yeah, they all are at this stage.
Yeah. It's that
Anyway,
time of the year, isn't it? This is like Thursday of the year when you get into
yeah.
October.
So we had some unfinished business in the oil. I talked about that it could happen. Um, we had a confirmed high here, Ryan. And, this was, I did 4 trades within this. I want to explain something to people because, I got some comments on the YouTube video that I just want to show you something. Okay. So, this was my first sale. It wasn't so good. It was Sunday night and I had a drawdown, but I made money. Okay. Here was my second entry was up here around 82.80. I, had a little bit of a drawdown, but made money. So what I do is when I take partials, I move stops to BE. And then I sold it here in case we didn't make a new high for divergence with plans to sell more at new highs. This was my most accurate sale, made money. And knowing that the RSI confirmed that we were going to have a new high, I sold some here and I was going to sell more. I had an order in at 84. It didn't get there, but the 83.60s did, making money. So if this turns out to be the top and we need some more downside action, it's early in the day. I don't think we'll get a 2-week reversal because that's going to take 79.50. That would really surprise me. But I'm just showing you the example, attendees, okay, that if you're in trades and you're not taking partial profits, if I hadn't have taken partial profits, it would have been, could have been a nothing week, that I, took heat and stress and didn't ring the register. So if you have 100 pips in crude on whether you're long or short and you don't ring the register, you need to go back to the drawing board, not on all of it, on just part of it. So, we're traders and, no one pays us an hourly wage, right? Or a salary that means anything. So you have to take something and ring the register to generate revenue. Okay, so it's just money management. There's no technical thing to it. It's just, what you feel like is enough. You need to book partial profits is really the lesson.
That's
Um,
that's uh, that's top advice, Dale.
yeah,
That's something I've been doing for the last 2 years. I'm not a short-term trader by choice. That's not my bag. But the volatility over the last few years, has been so low. And like we've been saying, you can't trust a trade often.
yeah,
So you get in the trade. If I get in the trade and I'm 10, 15 pips up, I'm slicing some.
right.
Get the risk down as quick as you can. That's what it's all about. And then you can sit back and see where the trade wants to go.
Yeah, if it runs, you're still there. And you know what? If it takes time to evolve and you're taking partial profits, you have more confidence to continue to do it because the market is rewarding you, not for anything huge, but you're being rewarded. You have more confidence when you're coming off trades where you've made some money instead of losing some money.
Yeah.
So it also helps your psychology. So I just wanted to stress that because someone commented, well, crude yesterday after crude rally, a lot of people like to see you be wrong. Now you have sarcastically, now you have another chance to sell it. Actually, he was being sarcastic, but he was right because that's what I did. So I just wanted to stress that to you guys. If you're not doing that, please try it. Okay. Um, you know, please try it for a while and see if it makes a difference. I know it will psychologically for you, and I'm pretty sure it will financially for you. Um, I think there's a chance, and I'm still looking for higher levels in the end. and we could get one more push up above this high. Maybe this is 1, 2, 3, but I'm with you, Brian. I think we're going to pull back to 1260 or so, or where did I have that moving average? Yeah, maybe back down here if we could take out this, little breakout and then make the move up towards the 116 level. So we'll see. I think it's late in the game, at least. There's going to be a correction, whether it starts from up here or down here before we go to 116. During this whole period of dollar weakness, the euro could barely get out of its own shadow. And something I was talking about with Blake the other day, it may be happening if crude does follow through to the downside. This certainly looked like a three drive formation in Canada right here. I think we were talking about it yesterday. You guys were talking about some bank that was looking for 120 or something, Ryan, and you said, "Oh, you got to buy it now." They were great to fade, but you look at the 4 hour, and that's pretty good looking form. 1, 2, 3, and the third drive, it's glaring. I mean, you don't even have to get a reading to know that we've diverged twice now above 30. So I'm not saying that it can't, continue to probe these levels, but I think we're close in Canada. So uh, that's about all I have to share this morning. I'm a little bit surprised. I thought we'd take out this 93.50 level. In fact, we probably still can, because look at the character of this bounce, which I wasn't impressed with. So if I wasn't impressed with this, how could I be impressed with this bounce off the same level? I think they need to take it out and get people um, a little less bullish a dollar, maybe go down to 93 or so. I know some people are saying if we start closing under 93, there's something bigger happening to the downside, but that's probably, that would mean taking out 17 and a half in euro, and I don't think we'll do it. So
Still looks
that's
a long
it.
way away, doesn't it?
Yeah, it's taken its time, and EG, it's tempting. I haven't done it yet. It hasn't done anything right, but sure hanging around after breaking down, hanging around here, and at new lows on most time frames, it's not going to confirm. So just I know people aren't you know pushing the short side here, but I'd be careful with the short side. Here again we're diverging, um, and the big picture on the daily, you know, looks like it could be a wedge developing here, and we're hanging right on the wedge line. If it continues lower, the way to trade it is, if it continues lower, you let it go, but then next time back inside this wedge line would be a signal to go long. And that's all I have for TGIT. Is Stella on?
I sure am.
Silver, what a move in a week.
In what?
Silver.
Oh, silver. Yeah. You know me.
Yeah.
I have it, and I'm bullish. But as I've said to I said this yesterday. I said to a friend of mine, we're not out of the woods. We haven't broken out yet, and really gold needs to break out first, which is gold is closer to breakout around 1840, 1850. I can't remember exactly what the level was, but we're still they're still moving, and the question now is what's going to happen with the Fed, because really they're driving everything, and the market's pricing in basically what they're telling us that they're going to do, which is taper starting either this month, either November or December, ending first half of 2022. And the question is, are they going to keep up with that pace or not, or go at a faster pace? And as I said yesterday, I think faster pace is kind of out of the question. I think. I mean, I don't see it. Though, it could happen. If inflation starts going ballistic, then maybe they do something faster. But I don't see how it's going to be. So I think the risk is still for the Fed to be to surprise on the low side, on the kind of dovish side. Now we're seeing stocks today a little bit lower, 0.2 lower in the S&P. Is it a generational low? Shall we get in and buy it while it's down?
Yeah.
I'm kidding, but it's if you take out COVID and those 3 weeks or however much it was, 3-4 weeks, we've just been in a straight line. And
I'd like to buy gold down here. What do you think, Stel?
whereabouts? Oh, sorry.
Around the 1740 to 30 level and risk these lows?
Yeah, you could do that. I've said before that I still think that 1680 could get challenged. All it takes is a couple of days of heavy selling, and we've seen those in gold and silver so many times in the past for no apparent reason. With things not really moving, but they can happen.
Yeah.
If we get anywhere near there, I think that will be great risk reward long.
And I know you're in this, and I've been watching it to see if it would show greater strength than just gold shares, the silver juniors.
Yep.
And we've had a nice little move off this, and really yesterday it was up 3%.
Yes.
With Newmont up 0.3% and Yamana up 0.7% and GDX up 1%. So the junior silver miner ETF is beginning to outperform. I'd buy it down here between $12.40 and $12 if we got a pullback. Because if gold goes to 1740 or so, what's silver going to pull back to 22 and a half or something?
Yeah, could
I'll use gold to key off a silver buy, but the SILJ is outperforming the gold shares in the last week or so.
Well, yeah, because silver has been outperforming gold, and
Right.
the junior miners are very high beta. They kind of exaggerate the move. Silver is up 1.5%. They're up 3%. So I have that, and it's very volatile. So it's not it's not the safest thing to trade. It's
safe and trade is an oxymoron.
Yeah, true. And but yeah, I think we're on the right path. But the Fed could easily derail that. If they come up in any way more hawkish than we are currently expecting, you can expect to see these gold, silver, and miners just fall off a cliff.
And look what it held. Look what it held here on the weekly.
Is that the 200 DMA?
Yeah.
Oh, 200 weekly. Oh, yeah.
Yeah. And also, it only retraced 50%. I mean, compared to GDX, retraced more than 50%. Yamana was more than 50%, and Newmont. Yeah. So anyways, go ahead.
The big picture, though, is that we've had a good impulsive move higher, and we're correcting now. That's for me. That's the bottom line. So I still like these trades, all of them. And as I said before, unless we get some major surprise, nothing's changed. I don't see how they're not gonna perform. But obviously, these are famous last words. And what about stocks? I still think chances are that we're going to be green on the close again, because there's no economic data today or tomorrow, not major ones at least. We get some Philly Fed and jobless claims and PMIs, but really nothing that's going to be a huge market mover. And nothing's changed. So the path of least resistance still seems to be to the high side, as is for cryptos. Yesterday, we talked about Bitcoin, and, I said, if you put a gun to my head, I think we're going to see a new all-time highs. And we saw them a few hours ago. And yes, they're down a little bit today, but really they're, what's to stop them?
Look at that divergence on the weekly, guys. Look at that compared to the last all-time high.
Yeah, that's a good point, actually.
Hey, good morning, guys. How are you?
Good morning. Good morning.
Blake shorting $1 million worth of Bitcoin right here.
I'm gonna admittedly tell you, I was long. I was long Ethereum at 37.50, somewhere around there. And the Bitcoin ETF launched, and I'm sitting there like long Ethereum. It goes up to, I don't know, 3,800 or whatever the price was, and it just sat there. I'm like, and I was like, I don't think it's gonna move, and so I pulled it off like an idiot, and yeah, we hit almost 4,400 this morning, and now we're coming off quite aggressively. Big profit taking coming into Ethereum right now. So we hit the 127% extension, and just we're coming off pretty good. So
you're taking your son's signals, man.
Yeah, I am. I totally am. I totally just taking cues off the kid. So no, you know what? It's funny. He hasn't even been trading crypto. He's like, he's like, the movements haven't been big enough, so I'm not even trading.
Oh my God.
So yeah, he's out trading some biotech stocks now. It's like crazy. It's anyway, how are you guys doing today?
Good, bro.
Good.
Hey, it feels like Friday.
It does. Yeah, Estelios keeps getting up and saying, he welcomes everybody in the morning, saying it's one day closer to Friday. So I think everybody's looking towards it. We had some really big reversals last night in Asia, and I got to point a lot of those out. Ryan, when you got up this morning, I guess I'm asking you too, Estelios, when you guys got up this morning, did you guys look at the market and go, holy cow, we really hit some key levels?
What?
No.
In what? Sorry, have I missed something?
Okay, let's go ahead. Let's review. Let's quickly review. All right. So first and foremost, Euro, once again, we're stumbling on, this previous support, current resistance. It's the 116.70 levels. Some is a level that I've been trading against for the last, few days. The Aussie, almost the 200-day moving average, 50% retracement, channel resistance, big reversal. So if you're caught with your pants down chasing the Aussie on a breakout, you have your pants down right now, and they're wrapped around your ankles. So then you have like the Kiwi hit the 618 retracement. I'm giving you guys a lot of stuff that our ForexAnalytix community gets every day, because we do top-down analysis for all the major currencies every morning after we're done here. So but I need to point all the stuff out that has been very hot on our radar as of late, because this is where we derive all of this information here. There's a Kiwi at the 618 retracement. Dollar Canadian, we hit brief new lows below 123, tripped a bunch of stops and reversed higher. What else is big? I was looking at the Euro Mex, which is a big risk off type of indicator for myself. We've been in this descending wedge, and then we probed the 200-day moving average. What was it, 2 weeks ago? But what you're seeing here is you're seeing the Euro Mex not make lower lows. Now, in my opinion, that is a train wreck waiting to happen. Meaning, if you are long Mexican pesos in any way, shape, or form, if you're long emerging market currencies and you're long Mexican pesos, and you see this descending wedge coming off of these highs, this has been ever since the post-COVID highs, or this would be the COVID lows in the S&P. You can see we've been in this descending wedge. Now we're not making lower lows. We're getting reversals off of these lows, and we're making higher highs. And we break above this. Yeah, this thing could really squeeze if stocks come off. Now, you just heard me say it. If stocks come off, yeah. Well, that's when's that going to happen? I don't know, because we just hit, or came really close to all-time highs once again. But notice how the Nasdaq's kind of stalling here at the 78% retracement, head and shoulder pattern developing. Why is that happening? In my opinion, we've got yields that are puncturing or testing a major, triangle breakout area. And, if yields, I know,
Still chart of the day, man.
Well, that was the 10-year yesterday.
Yeah.
So the 10-year was my chart of the day yesterday. And I do think bonds are moving lower. And we should be.
I keep an eye on you, man.
Hey, cool. Okay. So here, let me give you guys some other flavor. 2 days ago, I had an opportunity to meet with Kevin Ferry. If you guys don't know who Kevin Ferry is, you got to watch the video that's coming out on Trader Summit today. It might actually be out this morning. It might be out within the next hour or two. Kevin Ferry and Mark Chandler, actually, who is coming on with Dale today, will know exactly who Kevin is, because, you know, Kevin was every morning on CNBC with Becky Quick and Mark Haynes and, you know, Joe Kernan. Like for a decade, he was on the CME floor every morning giving an update from the Chicago Mercantile Exchange or the CNBC studios. You know, what are futures doing? What's the market doing? Blah, 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 for at least a decade. Anyway, he's a friend of mine. I actually saw him 2 years ago in California, and he's venturing back into the markets after, you know, the last, I want to say 6 or 7 years of kind of, I want to say retirement, semi-retirement. He's got his, he's kind of busy, but he's still always been in the markets, and and he's a big bond dude. I mean, he's like the bond, he's like the man when you're talking about bonds. Anyway, he is extremely bearish in the 10-year, and we were discussing about how 10 years ago, when he came and met with our group of traders, actually Rick in our chat room had an opportunity to meet him 10 years ago. We were laughing how the bond market is exactly the same spot as it was 10 years ago, and he was extremely bearish back then. And we were trading right around this level around 2012, and you can see that the 10-year just came unglued. But that was, you know, the first time I actually met him in person, and I'm like, how do you feel about the bond market now, 10 years later? He's like, exactly the same as I did 10 years ago. And so, but he, you know, for all the different reasons. Anyway, the point being is, if bonds continue to sell off, and you guys don't want to miss that interview coming out today, because he has not made a public appearance in like 6 years. So just FYI. Anyway, if the 10-year starts to break out higher, this is where Stelios, you know, Stelios, you've always said there's a breaking point, right, where stocks go.
Yep.
I'm not so comfortable with.
We're getting close now. We're getting really close.
Yeah, I mean, I would say we are getting pretty close to that. So, hey, Rick said, I met Kevin. That's right. Rick was in our event. That was 10 years ago, wasn't it, Rick? Rick was in our, sorry, I just saw his comment. But yeah, anyway, we're getting really close to that breakout point. So what are your thoughts here? Oh, I'm sorry. Before I ask that, I got to show just a couple other things, guys. With when I asked you, we saw some key reversals last night. Let me show you just a couple other quick things, really quick. And then I want to get your opinions here. So Euro Yen, we're still, you know, pretty close to the AB equals CD move in the Euro Yen. Sterling Yen, or the guppy, 127% extension, over exceeded an AB equals CD, but you know, the sterling's been kind of outperforming last week or two. Aussie Yen, false breakout 2021 highs that came in Asia overnight, and then complete reversal here. Kiwi Yen completed an inverted head and shoulder pattern to the pip and reversed in Asia last night. Canadian Yen, 127% extension. I am expecting a pullback in the Canadian Yen for a dip to be a buyer down at 91. But the reason why I'm pointing all of this out is because if yields rally, the yen pairs may actually succumb to some selling pressure. So, all right, with all that being said, and I'm not even going to go through the rest of the cross rates that I think have really hit some key levels overnight, but I will on the ForexAnalytix webinars for our community here in the next couple hours. What do you guys think? What are your thoughts here?
I think we're just seeing some natural pullback. You know, these yen pairs have been rocketing for weeks.
10 days, weeks, right? 10 to 12. Yeah,
22nd of September, I think it was. When it started kicking off.
Yeah, I mean, here's the Canadian yen.
Yeah, I mean, you know, you can't have markets going one way like that without any sort of pullback. But the pullbacks are shallow. You know, you can't even really call them a pullback. I mean, you look at the fib there. You know, how far away are we from the 38.2 of that?
Oh yeah, I mean the 38% retracement is
just of that move is
right here, 87, and we're 505 big figures higher. So that's just the Canadian yen that I'm looking at. And
exactly.
by the way,
even the fib off that move from the September to that high now, you know, there's a 38.2. It must be, you know, down around 113. Something like that. You know, I was looking at Aussie yen because I'm starting to look at building a long Aussie position for the RBA. I'm looking at where I want to get in.
Wait. Are you building a short or
long.
a long position?
Yeah, long.
Long.
I had one of my moments where when I get early-itis, where I get twitchy, and you know, as you've heard on these webinars, I've been wanting to get in Aussie dollar for a couple of weeks now, and either I didn't bother or I don't want to chase it. So yesterday I bought the break at 75.
Hey, Ryan, is it me or you're coming in really jumbled up?
Yeah, it's not you.
How's that?
Oh,
how's that? Is that better?
Yes, much better. Yes. So yeah, continue.
So I was saying that when I go for a long-term position or a longer-term position, I usually get a case of early-itis, I call it, where I always end up going early because I get that FOMO because I want to be in. I've got a plan and I want to get in. So I bought very, very small at 75.12 in Aussie dollar yesterday, just to scratch the itch. I mean, it's beer pips size. You know, if it goes to 60, I'm not going to lose.
Okay, let me delete this. Let me delete this arrow for you really quick. Sorry.
Yeah. Okay. But I want to see a decent pullback, and I'm happy to buy Aussie dollar down to our magic 70 level. But I want to spread over some exposure. And I was looking around the pairs, seeing, you know, where am I going to get in? You know, Aussie yen, it's crazy. You know, the 38.2 fib of this move, you know, is way down at sort of 83, 82. You know, we're really high, and I want to get a dip. But there's a couple of pairs I'm looking at. So it's Aussie dollars one, Aussie yen if we get a decent pullback to sort of the low 80s. And the other one I think is good is going to be Aussie dollar Kiwi, because that's really showing. I'm looking for clean central bank divergence trades, and we know the RBNZ is hiking. You know, and you know that's pretty obvious on that chart there. We're seeing obviously the Kiwi gain, and when they're probably going to be finished hiking early to mid 2022. Meanwhile, the RBA is still jawbone in 2024. That's potentially going to be a big snapback trade. So I'm looking to get in, you know, maybe down towards that 103 area, those lows down there, start maybe building a position into that. Just getting set up for a long-term trade. But you're right, you know, going back to what you're saying, these yen pairs, they've been on a rip and they're showing no signs right now of any sort of decent pullback.
Yeah, you know, and we've seen some. Now, when's the RBA meeting? Is it next week? I think is it next Tuesday? Monday?
Sure next Tuesday.
I think they meet on.
It's November. Is it next week or is it November?
Oh, maybe it's in November because their meeting minutes are next week. So that means that we're a couple weeks away. Yeah. So you're right. We got a few weeks regarding that. So
let me double check.
All right. So
second and off.
I think that's a pretty sound advice as far as the Aussie goes. So Stelios, let me ask you. So now that you've seen some of the key levels, did that open your eyes on what happened overnight?
Little bit, but we haven't really broken anything major. Actually, I just wanted to say one thing. Our friend Eugene is saying if stocks are in jeopardy and bonds are in jeopardy, what do people do with their 401ks? And
well, you know, let me answer that really quick. Yeah. When I say if we say stocks are in jeopardy, I mean, look, I just wouldn't be surprised if we're in a 4,000 to 4,500 range in the S&P. And if you're really about trading your IRA or 401k or stock market retirement, I think that's a mistake, right? I mean, unless you're like,
It's supposed to be a long-term thing, right?
yeah, I mean, look.
By the way, we have data in about 15 seconds.
Oh, okay, that's
just so that you don't say I'm
CPI.
sleeping.
Yeah, you're on it today still. Espresso.
All right, hold on. Let me grab the.
Dale's drinking espresso.
You guys get data flash with your ForexAnalytix subscription. So let's go ahead and pull over the
Dale Flash.
Dale Flash.
The Dale Flash.
Nice.
All right, here we go.
Okay.
Jobless claims are
slightly better. Revision
Wait,
slightly worse.
Didn't we have Canadian inflation data today? I'm off a day. Am I off a day?
Wasn't that yesterday? That was yesterday.
Geez, I am off a day. See, this is what happens when you get up and only have a few hours of sleep. When you get up at the 3 o'clock hour. Anyway, all right. So
you're gonna have an extra hour pretty soon. Stop complaining.
I cannot wait. Hey, look, we're
to your house.
Mark Chandler. Mark Chandler is going to be on from Bannockburn. I'm excited to have him here. I always enjoy having a conversation with him, but the one thing I want to ask him, and Ryan, we were talking just about the yen pairs just a moment ago, and if you missed the Traders Summit interview with Mark Chandler, and Mark, he's here. I got two things I wanted to ask him. So when you bring him on, Dale, I want to ask him about something that actually, you can see this interview right here. That's from Michael Brown at Caxton FX, which is was introduced to me from Ryan. So thank you, Ryan. He said something that's really interesting because Bannockburn and Caxton are in the same business. They work B2B a lot for FX, corporations and whatnot. He said something was really interesting. So I want to ask Mark about that, if you don't mind, Dale.
Oh, no, go ahead.
Oh, okay. And then
I've set him up as a panelist. So let's just ask Mark to unmute. Mark, welcome back. Blake has a few questions for you.
Hey, Mark.
How's that?
There, but
I'm here.
There you go. All right, Mark.
Mark, how you doing?
Good, sir. How are you?
Good. Hey, I'm going to let Dale. I wanted to let Dale take over the interview here in a second. But as we spoke last week, and if you guys didn't catch his interview on Trader Summit, you go through and you can go down to the videos and find Mark's most recent video. We were discussing the move in the yen, and as you had, well, maybe I can let you elaborate on this. The dollar yen has moved up aggressively, and so have all the other yen pairs since we spoke. I mean, I think we've moved, maybe two big figures since you and I spoke, from the 112 to the, near 115 range. And you had some pretty enlightening insights regarding the yen and as far as ranges go. So do you mind talking a little bit about that, as far as, because a lot of people look at the yen and they go, wow, it's really breaking down. We could really start screaming higher, but you have a little bit of a different view, don't you?
Yeah, I think that, so it's just really a subjective experience in the markets. I think that I sort of see the dollar yen pair as primarily a range trading instrument. And when it looks like it's trending, it's moving from one range to another range. And so I'm thinking first, maybe talk about the driver. I see the real driver, not something going on in Japan. They're going to have elections in about a week's time on Halloween. And I don't think that matters so much for dollar yen. For me, the key driver is U.S. interest rates. Very strong correlation. So mathematically, it seems to be a fairly robust relationship. U.S. interest rates rise and the dollar yen goes up. There might be different reasons why U.S. interest rates rise. I see a very strong correlation between higher oil prices and higher break-evens. That is, people see higher gasoline prices, higher oil prices, and they imagine there's going to be more inflation, drive up U.S. yields, and that drives up dollar yen. But if the dollar yen is this range trading pair, then what we're fishing for now is the upper end of what's going to be the new range. And when I look at the charts, I don't see it so much on what you have up here now. I'd go back a bit longer.
116.5, Mark?
Yeah, I'd go back a bit longer, but I sort of see this 115 area as important.
Okay.
And so I thought that, and we talked about this, Blake, I guess last week or 2 weeks ago.
Blake's got a trend line. at
Yeah, I was thinking that
116.40.
that the upper end of the range, at least initially, or like the initial guess, is the 114.50 to 115 area. And so far, the market has split it. I think we got a high yesterday about 114.70. Even though we dipped below 114 this morning in Asia, it didn't move back above there. I think as long as it holds above the 113.80 area, this still looks good to keep probing that upper end of what I think is going to be that new range.
And this is a
And
weekly chart.
yeah,
I was just going
and
to say
why would,
those are those levels.
and so I think to myself, why would, if I'm saying the dollar yen is 114.50, 115, and it's driven by U.S. interest rates, what is going to get U.S. interest rates to stabilize? And I'm not sure about the long term, but at least in the near term. And here's what I'm looking at next week. And this is, I think, very much like how I think you guys think about prices. You're not just thinking about what's happening today, but how it fits into the bigger picture. What's the next, like in the pipeline? What's the next thing to be anticipating? Same thing I have to do for macro. And so one of the big pieces of data next week is going to be the U.S. GDP, Q3 GDP. And what's interesting about it is that expectations have fallen. When I mean expectations have fallen, I mean they've really fallen by a lot. The Atlanta Fed, so the New York Fed has stopped doing its GDP tracker as it tries to rejig it in this pandemic environment. But the Atlanta Fed presses on, and they have cut their model of GDP tracking, making it an accounting function rather than a forecasting function. They are looking at 0.5%. That's an annualized pace of growth that the Atlanta Fed has for Q3. The market is above there. But if we come out anywhere close to that, I think that the market will conclude, so the market's already biased, I think, towards the stagflation type concept, high inflation, slow growth. And we get something like that 0.5 that the Atlanta Fed is looking at. And I think that bonds would rally, that is, yields would fall. And as yields fell, we'd see a big recovery in the yen on the crosses as well as against the dollar.
Interesting. Wow. Well, Mark, thank you so much for your insight on the yen, because I think a lot of people look at the dollar yen, they're like, oh man, here we go. We're going back to the 120s, maybe even higher. So I think it's important that people hear what the drivers are for the yen currently. And to your point, rates are moving higher, and we've had a strong correlation between the dollar yen and rates are obviously probing some pretty key resistance. But as you pointed out, maybe some of the economic data, if it's showing signs of weakness, maybe it's not that time just yet for rates to move higher. I got one last question. I'm going to put myself on mute and let Dale take over, but I talked with a gentleman, Mr. Brown, Michael Brown from Caxton FX in London, in the city of London. And he does very similar work that you do at Bannockburn with a lot of corporate clients, moving money based on, their businesses, whatnot. And it was interesting. He's like, he goes, I think the market's pricing in a lot of rate hikes. And he specifically was talking about the Bank of England, but we were also discussing other central banks. He goes, and he's like, I just don't think that other central banks have the ability to deliver on these expectations other than the Fed. So, and I think the comedic part of his interview was that look behind me and on my windows up here in this high rise, if you see pigs flying, we'll see that before the ECB actually raises rates. So, the point he was trying to make is that really the only central bank that can deliver on its promise of really tightening monetary policy in any way, shape, or form is the FOMC. Do you have any, and which makes him by default a dollar bull at this stage in the game? Do you have any opinions regarding that? Because I thought that was some pretty good insight from that side of the business.
Yeah, I mean, I do think that the U.S. has among the fastest, the strongest inflation readings among the major industrialized economies. We've had the largest fiscal stimulus, and remember, we had a lot of stimulus even before the pandemic struck. And so it does make sense, higher inflation, strong growth, lots of stimulus, that the Fed would be aggressive. But for me, the Federal Reserve is not leading the pack. If this was a swarm of bees or the birds migrating, the Federal Reserve is not in the front of the V or the front of the herd or the front of the bee swarm. In fact, it seems to me that Norway's already hiked rates, promises to do more. I think you mentioned it before, New Zealand's hiked rates. They want to do more. The Bank of Canada meets next week. They've been pretty aggressive. They're going to taper further. But, the market's pricing in roughly 100 basis points from the Bank of Canada and the Bank of England in the next 12 months. That is well before most people expect the Fed to raise interest rates. But that's what strikes me about what's going on, too. The market is getting very aggressive. And I've been talking about this for a couple of weeks, and the market's getting even more aggressive. But here's what I'd be looking at. I had begun looking at the December next year Fed funds futures. I moved back to September. But here's what I'm looking at now. I'm looking at the August contract. And the August contract's interesting because the Federal Reserve does not meet next August. So this would give us a gauge on what to expect, what the market's expecting for July. And the idea is that the Federal Reserve has indicated that it'll be done buying bonds. It'll be done sort of winding down QE around the middle of the year. So it seemed that July would be the first chance that the Federal Reserve would have to raise interest rates.
Yeah.
Assuming that they don't do it, fair value is about 8 basis points for that August contract. It's trading at 26 basis points now. 33 basis points is completely factoring in a rate hike for next July. So I sort of sitting here, and the market seems to me to be pricing in about a 60% chance of a rate hike for July next year. And remember, last month at the FOMC meeting, only half of Fed officials thought there'd be a rate hike at all next year. The market's pricing in one almost as soon as the Federal Reserve can do it when they get done tapering.
Well, thank you, Mark, for that explanation. And I'm sorry, I'm going to step away. I'm going to let Dale go into that, or into the rest of the interview. But I wanted to say this pricing that we're seeing from, with, all these other central banks, and I think we all understand that, a lot of central banks have already started to move, but the future pricing movements have been really, really aggressive. So.
Yes, the market is very aggressive about the Fed. The market is pricing in a strong chance that the Bank of England raises rates this year still.
Yeah, I was going to say that, and I think the point was of the last conversation that I had was that they can't deliver on that, or they're not going to be able to, is what I think Michael Brown was saying. And I was wondering if you agreed with that.
Yeah, so I think that the market is getting too aggressive. I do think that the Bank of Canada can raise rates middle of next year. I think the Federal Reserve, I think one hike is a safe bet. 2 hikes is pushing in the U.S. I think a rate hike as early as early November that the market's talking about for the UK is a bit early. I think that, again, for me, the problem is that just like inflation is supposedly transitory, growth is as well. And I think we're going to begin seeing that weaker numbers. Starting tomorrow, we're going to get the October PMIs, and we're looking at slower numbers, weaker numbers across the board. So I think that for me, the big danger, monetary policy, like fiscal policy, becomes pro-cyclical. So I agree. I think the market's leaning a bit far over its skis.
All right. Well, and we're going to be getting PMIs not only from here in the US, but we're going to be getting them all through Europe tomorrow too. So it should be an interesting read. So Dale, are you there?
Sir.
Hey, I'm going to let you take over. Mark, thank you for addressing those questions for myself and everybody listening in. I always appreciate hearing you guys. I don't want to take any more of your time with Dale. So thanks and enjoy.
Thanks for being here, Mark.
Good luck.
No,
Catch you next time. No, I'm kidding.
No. You always ask the right questions. I had to ask a couple. All right. I love chatting with Mark. So I'm out of here.
All right, Mark. So I'll be a little bit off the wall. What's with this guy, Mark Carney, saying that we ought to abolish the dollar?
Yeah, isn't that amazing?
What did you think when you heard that, buddy?
I was a bit taken aback for it, especially because he came to the American heartland. He says this at Jackson Hole.
Oh, that's what he did. Unbelievable.
He comes to America and says that the dollar is part of the global problem. And I'm not sure what problem it is. Of course, you have many central banks have the dollar as a primary currency and reserves. And of course, in the ideal, utopian world where beer comes out of drinking fountains, there'd be other currencies to share that burden. But the world in which we live in is not like that.
Yeah, he's a kind of a journeyman central banker. I think is he playing anywhere, or is he on waivers waiting for another job? Where do you think he'll be? What central bank will he be playing for next season?
Yeah, I think that what's interesting though to me about him is that he's moved over now, leaving aside the central banking functions, because as you know, he was like the head of the Bank of Canada and then the Bank of England.
Yeah.
Some people talked about him at the Federal Reserve, but I think fat chance. But I think it's interesting that people of his caliber now are recognizing the importance of climate change in a way that they didn't recognize it, say, 5 or 10 years ago. And so he's really pushing that area now, thinking about what it means for monetary policy when climate's going to be more volatile, what it means for businesses. We see this already, right? I mean, when I was getting out of grad school, we had to read so much about the Japanese innovation in just-in-time inventories. And it maybe lasted about 30 years. And through this pandemic, but other supply shocks with the climate change, more volatile weather, we're seeing the just-in-time inventories maybe is on its sort of way out. People are thinking of other ways to manage inventories.
Yeah, it's interesting, Mark. What you and Blake were just talking about is happening on my screen. Maybe where yields are going to weaken into the GDP reading. If you look at this chart, we have some pretty good divergence, like a little 3 drive on it. And I was thinking before we took out 178, which were the highs in back last spring, that maybe we could pull back to 148 from here. And I wasn't aware of GDP next week and the number that's coming in. Also, the yen, same type of signal that I'm bullish, looking for higher numbers, but I don't know why we couldn't have a 200 pip pullback here. Maybe back to, this was a big breakout area, maybe 1250 and then higher. So the scenario you were talking about for the GDP may be sell the rumor, buy the fact after the number, instead of the other way around. So
yeah, I think that's important, Dale. Just that whole idea of buy the rumor, sell the fact. I think that's something that's really unique to the markets. Most of the rest of our lives, we think of cause and effect. Cause takes place before the effect, but here we're talking about people, say, selling treasuries in anticipation of strong data, higher oil prices, and when we get something, you have to you make that adjustment. We anticipate. I think that's really the great value of the markets, is the anticipatory nature of it. Not that we get it right all the time, but we're always anticipating. We really live in the future.
Yeah, I know. I'm really only 40 years old. So, also something that kind of could play into your scenario for yields to drop and the end to pull back is, last time I talked to you, you said that, every time that in your career oil prices have doubled, a recession has followed. And there is a topping formation that's developing that I've been playing this week. And if we had a break in crude, say, over the next month or so back to $70, that would also be a reason for rates to come down, and maybe even give the Fed a little cover so the market thinks maybe, like you're saying, how aggressive things are priced. That may be in November if we had a $10 pullback in crude, and we had that weak GDP number that at least temporarily, people, would give the Fed cover not to be aggressive at the November meeting.
Yeah, that seems to make sense to me. I mean, we did have that the oil inventory data yesterday. It sort of surprised the market. I mean, with the softness, I don't know. I mean, gasoline is also an issue now as well, and I see people paying more at the pump for it. But I wonder really, you know, the more we have to the more it costs to fill up the car with gas, the more it takes to heat our house, the less money we have for discretionary spending. And that ultimately is what drives the economy. So I'm looking at these higher oil prices and the weaker growth to be pointing in the same direction.
Okay. And, you know, I wouldn't be surprised, knowing the administration, it wouldn't be the first that he's hearing that the current administration's hearing a lot about high prices, and you know, people go to the pump every day, so it reminds them every day they go to the pump probably more than they go to the grocery store. And so I wouldn't be surprised to see the administration um, do something with the strategic petroleum reserve and release some. It may not be smart, but politically it would take some heat off them. What do you think?
Well, I think that yes, I fully agree. This is what, you know, how could the U.S. call OPEC and say, please produce more oil when we have strategic reserves and I
Yeah,
refuse to tap them? But having said that, it
yeah,
seems to me that the interesting thing about us tapping them, I mean, you know, China is also actively intervening in its commodities market,
yeah,
and people are shocked that they would try to do that to try to influence prices. But you know, the U.S. is going to tap into our strategic oil reserves, but not to drive, not the purpose, not so much to drive the oil down, but the purpose is to meet some budgetary compromise deal. That liquidation of some oil helps meet some budget issues, and it's
right.
just it's unfortunate. But I think that to me the issue here, and as you hint at, the rising price of oil, the rising price of gas, and remember, the food that we eat is heavily influenced by energy prices. The fertilizer, the pesticide, all carbon based, natural gas, oil, and so as people pay more for food and energy, what I see happening is the President Biden's support is waning, and that's what really concerns me on a on sort
Yeah,
of the 12-month outlook, that the Democrats may lose both houses of Congress,
yeah,
and that then brings into question about fiscal stimulus, globalization, internationalization. It just makes Biden appear to be possibly a lame duck this time next year.
yeah. Well, look at this. No wonder you and I are masochists and got into this business. We've been lifelong Cub fans. Well, anyway,
Multi-stock pick.
we know how to suffer. Uh, anyway, you know, I thought I was in the twilight zone when they finally got into the World Series after 100 years. So, Mark, it's always enlightening. I just want to cover one more topic, and it would be we're almost at a level you thought Canada could get to. Last time I talked to you, you're talking about maybe 122 by the end of the year. So, you know, we're starting to put in some type of little, you know, wedge type of formation. I know you're very bullish on the Canadian economy. Could there be an upside correction coming? Maybe if I'm right. I know you also, everyone listening, even though I do and many other analysts do talk about Canada and WTI together and the correlation, Mark says it's not a petrocurrency. So what kind of currency is the loonie if it's not a
Yeah.
petrocurrency?
Now,
Natural
interesting.
resource? Go
Yeah,
ahead.
no, so here's how I started to think about it. When I look at the flows of energy in and out of Canada, because remember, Canada imports expensive Brent oil in the east and
Okay.
exports the cheaper stuff to the U.S. in the west. And when I look at that and I compare it to the daily volume of dollar Canada, the capital flows still are much bigger than the oil flows. And so how do I think of the Canadian dollar? Well, if you tell me the direction of the stock market, the S&Ps, that right away gives me a directional bias because I sort of see the Canadian dollar most of the time trading like a risk currency. That is,
Interesting.
if you're indifferent to either the Canadian or US dollar, for example, your margin money could be kept in US T-bills or Canadian T-bills. What should you hold
Right.
it in? But when I see the stock market rising, that tells me people have an appetite for risk and will prefer Canadian dollars. Doesn't work all the time, but it gives me that directional bias. What I'm looking at is the head and shoulders. I think you have that sort of in the beginning of this chart. Head and shoulders breaking down, and the 123 was the
target.
Was my target. We got down to 122.90 or so last night. Maybe it's 88. And I think that's it, in the sense that I think now we should be looking for that upside correction. That this was sort of the last marginal new low that's not sustained. It reverses off of that. Whether we get that reversal pattern, a hammer candlestick, or a stronger reversal pattern, I'm looking at that 123.50. We get above there, and I think we get another leg up, 124, 124.20, and then we can come back off. The Bank of Canada does meet next week. I expect them to taper. So right now they're buying about 2 billion Canadian worth of bonds a week. I expect them to cut that in half and keep the market, encouraging the market to really look for a rate hike in the middle of next year rather than a bit earlier like it currently is doing.
Okay, Mark, thank you so much. I know, Mark, your reputation precedes you, especially into here. Blake and I rely on your outlooks and your insights on fundamentals, and I know thousands of traders do. So if you're not familiar with Mark, go to his website, marktomarket.com, right?
Marktomarket.com. And you can find me on Twitter too. I try to keep active there as well. There, it's my Twitter handle is Mark Making Sense. Comes from the first book I wrote called Making Sense of the Dollar.
Okay. And right here, Mark, where it says work with us, what are you looking for on this forum? People that businesses that may need some foreign exchange help, or are you looking for employees? What are you looking for here?
Well, we're looking for always looking for good talent, but we also work very closely with small, medium corporations as well as funds, and so what we're trying to do is, the thing that strikes me is that the large institutional players, hedge funds, large corporates, large asset managers, when you look at the euro, you see four digits on the other side of the decimal point. Well, in practice, those big pools of capital, they're paying, and there's another decimal point that you, as retail, or I, tend not to see. We try to make that more available. People, when we look at how small businesses, and this would probably include a lot of the retail, what are they really paying above spot?
Yeah.
Sometimes
they're getting ripped off, aren't they?
3 and 4%. So
it's
just
ridiculous.
like, when we buy something, we know we go to the store, we buy a suit, we buy a shirt, we know that we're paying a retail price. That same concept works with money. There's a retail price for money and a wholesale price for money. And what I'm trying to do, what Bannockburn's trying to do, is bring that wholesale price of money to people who are companies, funds that are often treated like tourists.
Yeah. Okay. Well, great idea, great goal, especially in times where, people have to watch every buck they spend, and profit margins being squeezed by materials and not being able to get parts, etc. It's a great mission, Mark, and it's always great talking to you. You're one of my favorite people to talk to and do interviews with, because I could ask you anything. I appreciate that about you, buddy.
Thank you, and good luck to everybody. Besides being smart, we need some luck.
Yeah, we're all for luck. Okay, I had some luck this week, and I'm grateful for when it happens, because I've had the other two. So,
yeah,
Mark,
sometimes if it wasn't for bad luck, I wouldn't have any luck.
I knew you were going there. And let me leave it with this, Mark, and I want you to think about this. What good is happiness? It can't buy you money. All right, buddy. Mark, thank you so much for your time and your insights. People are saying that was a great interview. They're thanking you, and have a great fall trading season. I'll be in touch with you to book another day early next year. Okay, buddy?
Great. Thanks. Good luck. Bye-bye.
All right. So good luck from Mark. Good luck from me. Remember, don't just count your pips, count your blessings. We'll see everyone tomorrow to wrap up the week. You could join the crew on the Morning Edge in 15 minutes. Oh, and you can't join the crew if you haven't subscribed, at least to Light. So if you want to know what's going on in there, you have to join. That's all. Invest in yourself. We'll see everyone tomorrow. Adios.